After two phenomenal years in the markets, many are wondering what comes next. Check out Rockline's 2025 market outlook. We hope you enjoy.
2025 New Year Outlook. Here are all of our wonderful disclosures, as always. And what we're going to cover today. We're going to go over relatively briefly what we all saw in 2024, which thankfully was a very, very wonderful year. We're going to go over some of the major headlines that we've seen so far developing in this last week or so in 2025. We're going to go over some retirement plan updates for those of you who might be contributing to retirement plans and still working. And then, just kind of our opinions afterwards. And then again, we're going to open it up for questions, and we look forward to it. So thank you. So first, looking back, after a few years of tightening to tamp down inflation, ultimately the Fed decided to start cutting rates. It was one of the quickest increases in rates that we've seen in history. And as we all probably know, if we had investments during 2022, it was not a wonderful time. If you did not have investments, but you were part of life around the world at any point in time, you probably experienced inflation, whether it was in housing or at the grocery store, kind of in gas and energy, pretty much all over. Definitely, was a little intense, certainly during the middle of 2022, the summer, June, July, and August. But we kind of have recovered a bit from there. Prices have stabilized. Not that they've come down all too much yet, but they've stabilized a bit. And the Fed had decided to cut rates throughout 2024, and we'll speak about 2025 in a bit. Stock market had incredible returns. The S&P 500 back-to-back years over 20% with 2023 and 2024. Also a rarity, but phenomenal nonetheless. And the economy stayed relatively strong. People kept chugging along, whether it was people that were working and able to produce enough money to continue to live and maintain their lifestyle. Some people might have had to take on maybe a little more work or look for other jobs. But overall, the economy remained relatively strong. The consumer remained very, very strong. And we think that'll probably continue going into this coming year. And then lastly, one of the most hot topics that we have discussed probably in the last 6 months was the election. We did have an election, and there is a new administration set to take place here in just a few days. So what exactly happened in the stock market? More specifically, just to look at the major indices, the Dow Jones finished the year up 12.88%. The NASDAQ finished up 28.64%. And the S&P 500 finished up 23.31% on the year. Again, pretty solid gains across the board. I think something that I would like to add in here is that what we saw through year end, specifically in the third and fourth quarter, was the broadening out of that rally. Largely in the end of 2022, going in through 23 and the beginning of 24, the Magnificent Seven, a term that you might be familiar with, comprised of the 7 top technology stocks in the market, really led the way, whether it was from just total returns as far as their stocks were concerned, but also from an earnings growth standpoint and as well as revenue. They did really well, but often criticized, that the rally was super narrow and that those 7 companies are not a great representation of the economy and the globe as a whole. So again, to reiterate, we did start to see that rally broaden through multiple different sectors through year end, which is definitely a positive thing in our minds. What did we see take place in the economy? The Fed went through cutting interest rates, a cycle of cutting interest rates. And I think everybody going into 2024 initially anticipated that the cuts were going to be more aggressive, certainly more aggressive, many more cuts, bringing our terminal rate down dramatically. And although they brought it down, it wasn't as far as we thought. They did finish the year with a couple of cuts that some might have questioned to say, are they actually necessary, being that the economy held up rather well. And that kind of brings me into the next scenario here. Again, very strong economy as far as the data is concerned, but market does seem to be softening a bit. You're starting to see, a little more weakness in jobs. You're starting to see wages kind of flatline a bit, all while expenses are kind of remaining rather elevated in comparison to, pre-2022. Jobs growth was kind of mediocre. It was okay. And depending on which statistics you look at and where those jobs actually occurred and were they full-time or were they seasonal, we did experience a little bit of job growth, but again, strong in general, but slowing down a bit. And then lastly, another very, very frequent topic that we speak about with people is the housing market. We hit multiple all-time highs as far as the average home price through 2024. Home prices remain elevated. And I think that that's very interesting. I think we kind of assumed a couple of factors. Number one, if interest rates remained high, that mortgages remained high, who knows what's going to happen then? Well, there was continued buying and continued super strong demand, and people continued to spend money. And something that we're seeing, I don't necessarily know that I would call it a phenomena, but something that we're seeing, if you're into reading about finance at all, something that's been spoken about the last few years is the quote unquote great wealth transfer. And depending on which publication you're looking at, it ranges somewhere between 70 to 80 trillion dollars in wealth is theoretically going to transfer hands between generations over the next 10 to 20 years. That doesn't necessarily mean, folks passing away and passing their money down through their estate. That could also be something that we've been seeing a lot of, in which case you're seeing the older generation help the younger generation purchase these homes. And that might be part of what's going on. Many people that are invested in markets have experienced tremendous gains over the last couple of years, and maybe gains further above and beyond what they actually need to live. And for a plethora of reasons, they want to gift money and help their children or loved ones move into their first home. And I think that is also part of that great wealth transfer. So you are seeing prices remain relatively elevated. I don't know with interest rates coming down if you're going to see that change anytime soon, but it is happening. I guess it's great for people that have owned homes for a long time to have that asset increase in value. And what happens in the future remains to be seen. Some of the headlines that we saw, again, the major headline here happened in November, new incoming administration. So President-elect Donald Trump will be sworn in on January 20th as the 47th president of the United States. Focus on his campaign was to incentivize businesses who invest and operate in the United States while putting tariffs on imported companies. He announced the potential for more tax cuts, mirroring some of the policies that he brought through his first term. And again, we're going to dive in more specifically in a second. So first and foremost, the Tax Cuts and Jobs Act, which initially is set to expire, later on this year down the road. It is now predicted that that will be continued. The Tax Cuts and Jobs Act will be continued, and that is potentially beneficial for a number of reasons. Tax planning, estate planning reviews, things like that is where that could come into play. Additional tax plans that are being spoken about. One of the major headlines is lowering the corporate tax rate for U.S. companies from 21% down to 15%. We think that that could be a positive thing. Tariffs and trade, also, again, a major, major headline. I will give you our opinion on that. I don't necessarily think that that is going to take place. And for those of you that are listening now that I've spoken to personally, I'm sorry, because you probably have already heard me say this. But I think this is more of a negotiation tactic. I think this is more of maybe just a little bit more of intense rhetoric. We went through this. We went through this back in 2018. And again, I'm sorry if you've heard me tell the story, but I do remember it very vividly. It's burned in my mind. It all kind of started in August of 18, where China and the U.S. were exchanging verbal blows, and then we started, putting on tariffs, and that accelerated through the end of the year. Most dramatically in December 2018, where, to my memory, if it serves me correctly, the market turned down from peak to trough about 20% in a month. So we already went through this. It did not have a great impact, in a positive way for anyone. And so I find it very hard to believe that we would go through that again, especially being that the members of the cabinet that are being nominated at this point, many of them have financial backgrounds, whether it is somebody like the proposed head of Treasury, Scott Bessent, or proposed head of Commerce, Howard Lutnick, just to name a couple. Many of these business leaders have experience, have current investment in markets. And I don't know, again, having already gone through this in the not too distant past, that they would want to go forward and do this again. I think that China in particular is having major economic problems, and to maybe potentially tamp down their aggression, that this is a speaking point. And then also highly potentially controversial scenario of immigration. And what does that mean? And I'm not going to speak from a political policy standpoint because I am not an expert in that at all. But I don't know that it's going to be as intense as what's being thrown out there. I think that we have seen major debate, especially in the most recent weeks, particularly the H-1B visas, where there are some of the brightest and the best folks around the world coming to the U.S. to work and help bolster our economy. And maybe we need to speed up a path for those folks to continue to stay here and build their lives and their dreams, and also help all of us prosper at the same time. So I don't know that you're going to see any of the majorly intense policy that has been thrown out there, but it is something that is on the proposed agenda. Economic outlook. So certainly, Fed is forecasting fewer rate cuts in 2025 than in 2024. If you look at the bond market, essentially, which is kind of a gauge on what investors think is going to happen, on any given day, it's a toss-up if there are actually going to be any rate cuts at all through 2025. Initially, it looked like they might lower by another full percentage point. Now, I think consensus is maybe you get maybe 2 cuts of a quarter of a point each through the year. The big debate, though, is it needed? And while there are definitely companies out there that might have variable rate loans, or individuals that have variable rate loans, or individuals that are being prevented from making moves in their lives due to elevated interest rates, other parts of the economy seem to be firing relatively strongly. And so if you lower rates too quickly, you could see a rerun of what we saw in the 70s, where you had a double-headed inflation monster. And we certainly do not want that to happen. And I think that is kind of what's going on right now. We've seen a little bit of choppiness in the markets the last few weeks, which could be for a number of things. Could be, year-end rebalancing, and then maybe taking, gains for tax purposes in the new year. So you have seen a little bit of selling going on, but you've also seen the 10-year bond, most notably, move higher in a pretty dramatic fashion. And I think that's bond investors kind of telling the Fed, listen, pump the brakes. We do not need rate cuts. Don't make a mistake. Right? Jay Powell, we have a quote from the famous Chairman Jay Powell here. I think we're in a good place, but I think here it's a new phase, and we're going to be cautious about further cuts. Kind of reiterating again, we don't necessarily need to jump the gun here and really just drop rates like a rock. It's a good sign that we're closer to normal than where we have been over the past 15 plus years, where we were experiencing rates, near zero, essentially. It was kind of free money. And I like to think of pretty much everything in a positive light. And so my spin on that and my thought process is that if, God forbid, there is some sort of crisis, a lever that can be pulled in a rather quick fashion is the movement in interest rates and the Fed's ability to do so. And so the Fed is signaling again, we're probably not going to be, fully gassing up our rate cuts going through 2025. I don't necessarily think that that's a bad thing. As I said earlier, the consumer remains strong. As of December, it's forecasted there's still, and again, a point that we've spoken about a number of times, but there's still over $6 trillion estimated to be within money market funds. That's a pretty massive number. And that does bring a little bit of comfort, because I feel like if rates do naturally fall, you will see that money come and spread out through different markets. It might be, people buying bonds and locking kind of higher rates in. It might be people buying stocks. But either way, that money coming off of the sidelines is great to stimulate activity and growth in the economy. And then we have the last statement here by the president of the Richmond Fed. Again, a strong but choosier consumer. That sticks out, and it's like, okay, you know what? Yes, we're not just throwing money across the board like we were maybe in end of 2020 and 2021 and buying anything we can on Amazon because we have all this extra cash sloshing around. Maybe a more responsible consumer. But the fact of the matter is, money is still flowing. People are still traveling. People are still going out and spending on a discretionary basis on the things that they want, by far and large, and that tends to be a good sign. Here's some numbers as far as the economy, looking through on a quarterly basis through 2024, and then estimates going into 2025 for the first and second quarter. And you'll see, again, I think the big picture here, things are kind of getting back to the historical norm. We're not in the recession, that again, some are still forecasting is going to happen, which has been going on for 3 years now. But we're not skyrocketing with growth either. We're kind of at, homeostasis, I guess you could say, which again, being that we shut the world down just, roughly 5 years ago, and everything stopped and came to a halt, and then the whole world separately tried to restart in their own fashion with their own rules. And now here we are today, not a terrible outcome. More years in the last 5 than not have been positive. So it's been a pretty decent outcome. And again, not amazing growth numbers for the economy, but certainly nothing that's ringing the alarm bells either. All right. And I'm gonna wrap up here before I hand it over to my partner Ant in 2025, the stock market outlook. Just briefly, a couple of bullet points. Continued corporate earnings growth. You're gonna have an AI revolution, in our opinion. Tariffs and trade are going to impact in some way, potentially. And then the watch out for inflation. And a couple of things that I want to say here. Again, we have a full steam of momentum going forward in that revenue growth. We're basically, about to achieve records here. We're 16 quarters in a row where we've seen tremendous revenue growth in publicly traded companies. We are 5 to 6 quarters in a row where we've seen earnings per share growth in publicly traded companies. When you have that much momentum going forward, in a normal world, that tends more often than not to continue. So we think that's a positive. We are forecasting that you're going to see some pretty great earnings growth going through this year. And that also kind of backs into the AI revolution. And I know everybody's speaking about AI, and everyone's probably sick of hearing about it at this point. But the main point that I want to make there, and again, for those of you who I've spoken to, I apologize. But I really do believe you're going to start seeing the use case for artificial intelligence in varying capacities spread out through all the different sectors of the market. It's not just going to be, the Mag 7 talking about in their earnings calls what they think the future will hold. It's going to be actual put to use artificial intelligence being implemented within companies, trying to drive efficiency and ultimately trying to drive profits to the bottom line, which I see as positive. All right. Ant, you want to take it away?
Yeah, absolutely. Yeah, a lot of what Gabe mentioned, I really think, in my opinion, that continued corporate earnings growth is really the backbone of what's going to drive the markets either up or down. And like he said, it has been a great 2024, record-breaking earnings. I see a lot of that again in 2025. Fingers crossed. There's a lot of different variables, especially the uncertainty right now, as we're in a little bit of an in-between in the transition of power between Biden and Trump. I think has stirred up the markets a little bit just because of the uncertainty. I think once he gets in and he starts implementing some policies, it will show a nice direction of where he's headed, and markets can kind of work behind that and get behind that and start working all in the same direction. So you'll see in this next slide, regardless of political affiliation, it doesn't necessarily matter of which side of the party gets in. It really comes down to strong corporate earnings, and our companies able to make enough money and grow year over year. Where is inflation at? And those are the two standpoints. I do not see it being a political bias of what drives the markets either up or down. It really comes down to strong corporate earnings. And as long as companies continue to make money, we should see the market continue to increase, especially with what Gabe said. There's still a lot of money sitting on the sidelines. So we would like to see that get put back to work because that would be a huge positive for more companies. We do have some retirement contribution updates. Some have stayed the same, but there have been some minor changes. The 401k, 403b contribution limits increased a tad, about $500 for 2025. It was originally 23,000. You are now to put away 23,500. And for those that are over the age of 50, you are allowed to put an additional 7,500. And this new enhanced catch-up contribution that they just put into effect for those that are between the ages 60 and 63, you're allowed a total catch-up of 11,250, which is an extra $3,750 higher than the normal catch-up. So if you do have questions regarding how much you should be putting away, please feel free to give us a call and we can go over this in more details. Other than that, I mean, they did change some eligibilities and catch-ups for solo 401ks and SEP IRAs you'll see here, but nothing too drastic. I think that the importance was they wanted to allow those closer to their retirement years to stock away a little bit more just to get them ready, because we do know that the retirement age seems to just be increasing, and they just want to have people ready and allow them to click that retirement button. They did have some changes to inherited IRAs. I'm sure some of you that are on here today may have had retirement accounts inherited to you. They did change that rule where if you were inherited after January 2020, you are subject to the 10-year rule, meaning that you have to start taking minimum distributions over a 10-year period. In 2025, this year, replacement of the stretch IRA strategy for non-spouse beneficiaries, they do have some exceptions. And if you do miss the required minimum distribution, as long as you put it and fix it and take that distribution in a timely manner, they will try to knock a nice penalty on you. So we try to avoid that at all costs, which is 25%. But if you do it in a timely manner, you could see that penalty go down to 10%. But we don't want to see you lose out on any penalties. So please, if you have questions regarding how much you need to take out, we could help you calculate that. It's definitely important to know that 10-year rule if you were inherited a retirement account. Some changes to Social Security. The cost of living adjustment for 2025 is 2.5%. Again, like I mentioned just before, full retirement age is now 66 years and 10 months for those born in 1959. For those born in 1960 or later, the full retirement age is now 67. So definitely, if you're getting towards that age and gearing up to whether you should start taking Social Security or not, and you want to help get some estimates, we'd be happy to kind of go through a little bit of an exercise and discuss all the different options of taking it either at full retirement age before or waiting till the cap age. The 2025 wage cap is set at $176,100 for 2025. That is up from $168,600 from last year, and that's to account for inflation. Changes to Medicare, a $2,000 annual cap on out-of-pocket for prescription costs for people enrolled in Medicare Part B. Payments can now be spread throughout the year. Medicare Advantage plans are now required to send mid-year notifications, letting holders know of unused supplemental benefits for the year. And there's been a crackdown on sales incentives for insurance brokers to ensure that they're doing what's in the best interest of their clients. And again, I think Gabe and myself and Sal and the whole team here at Rockline think that we do see some really strong earnings for the year to come. And again, we think it is the backbone of what drives the market either up or down. The economy and economic growth, as long as those earnings stay strong and consumers keep spending, which I think they will, we should see a strong economy for 2025. I do think, and I agree with Gabe completely, the trade and tariffs and putting the U.S. economy first. We'll see what type of tactic they'll take. As I said before, it is a little bit of an in-between, but as soon as the change of power happens, we'll get a better sense of where that's headed or how realistic these tariffs are going to be. I know there's a lot going on, not just here, but overseas. So I'm curious to see what will happen with the geopolitical outlook in the Middle East, in Ukraine, and I'm super excited for the AI expansion. I do believe that not only tech companies are using AI. I think you will start to see that flow into all different sectors of the market, and it will become a necessity for all walks of business, not only here in the U.S., but all over the world. So we're very excited for 2025. And Gabe, if you have anything else that you would like to add, thank you.
Thank you, Ant. Yeah, again, I think by far and large, and people, certainly say, okay, wow, we just had these 2 tremendous years, and what happens next? When does the shoe drop? When do we get the major pullback? Again, majority of the conversations we have, everybody's waiting for that major pullback, and you have the old adage, a bull market climbs a wall of worry, and I do believe that. It's when everyone's feeling euphoric that things start to get a little weird. And I don't know that we're going to see that at this point. You don't feel the euphoria. People are investing, but kind of like okay, here, like take the money and put it in, but let me close my eyes and not watch what's happening because I just don't know. Like you turn on the news and it seems like the world's going to come to an end at every moment in time, unfortunately. So yeah, I think overwhelmingly we do feel positive. There's going to be blips along the way. There probably could see some volatility here in these coming weeks. It's kind of a weird lull. You're waiting for January 20th. We're not seeing any new earnings or anything coming out in the immediate. So once earnings season starts to pick up, typically led by the banks and financials, that could spur a pickup in markets. But it's kind of a very quiet time right now. And I think you just see, again, investors churning in place and people repositioning and trying to potentially get ahead of whatever they might think will be the policy that we're about to see go forward. So with that, I will stop this screen share here and, we'll open it up to questions.